Of all the companies that I own, none gets a greater allocation in my portfolio than Mercado Libre. And of all the companies I own, none are more complicated to explain than Mercado Libre, something of a Amazon and PayPal of Latin America. And the company reported earnings after the market closed, and shares were down almost 7%. They've pared back some of those losses since, but it might leave investors wondering, is there something to worry about here? Let's spend the next couple of minutes figuring that out. My name is Brian Stoffel. At the time of this recording, as I said, I do own shares of Mercado Libre, which will be somewhere between $90 and $100 billion company when the market opens tomorrow. On the top line, oh boy, revenue grew 50%. Now, foreign currency neutral wasn't quite as fast, but you better believe this is a company that is growing fast. And that beat analyst estimates. On the bottom line, profitability did take a step back. Earnings per share shrunk by 11%, but that was to be expected, and the numbers came in ahead of expectations. Now, what I'm going to show you here is going to look ugly. Gross margins contracted by almost 500 basis points. Operating margins were almost cut in half. Net margins took a haircut. But almost all of that was to be expected. Mercado Libre has made it very, very, very clear that they are investing for future growth, not for short-term profitability. What that means is expanding their credit portfolio, which can be money-losing as it gets started, but also investing heavily in logistics and offering lower price thresholds for free delivery in Brazil. Did that help the company? We'll get to that in just a minute. Free cash flow expanded meaningfully, but this is a meaningless number because the company is a finance player right now. Net income did shrink, and it is worth noting that the balance sheet has way more debt than it does cash right now. But let's go down that income statement to show what happened. So first, revenue grew 50%. Very, very impressive. But the cost of that revenue was up 63%, not nearly as good. And that's why the gross profit grew by less than the revenue. Now, it's important to point out why that happened because the management offered up three main reasons. One is, as I said, the company is offering lower thresholds for free shipping, and that will cut down on gross profit. Number two is that their acquiring credit business had lower margin mix. Now, they said that there's two big reasons for that. One is just the point of sale devices that they give to merchants so that people can use their Mercado Libre credit card costs more. The cost of the chips that go into this, and surprise, surprise, we all know that the cost of chips is going up, was going up, but they held the prices steady when they're sending them to merchants because it is more of a loss leader. It's not something that they want to charge more for. And they also had to have a major restocking in Mexico because the credit card business is taking off so much. And the third is that they also offered for Brazil commerce, they offered for merchants and for buyers selling at certain selling prices to actually use a system called Pix, which is a little bit like a direct money payment. It is a much lower margin payment. They offer it, and the merchant is able to offer better prices, and they like it because they get the money immediately as opposed to using a credit card. And they also, and then consumers like it because the merchants can offer slightly lower prices because they don't have to pay merchant fees. And Mercado Libre is willing to make that change because they gain more market share, but they do give up profitability in doing that. Now, all of that said, operating expenses were also up a bunch. Now, the main driver, although not the only driver, is the provision for doubtful accounts because their credit portfolio keeps growing. Their G&A is pretty much under control. Their product and technology development grew, but not at an alarming pace. Their sales and marketing also not growing as fast as revenue did. So it really is that provision for doubtful accounts. That's not money that they've lost, but they set it aside and pretend basically that it's a loss for now. All of those factors combine to make income from operations shrink 17%. Net income actually was down 11%. But as I said, super complicated company to understand. So to really drill down deeper, we're going to go to fiscal.ai. So as I said at the outset, there are two main businesses here: the commerce, like Amazon, and the fintech, a little bit like PayPal. So how are these two businesses doing? Well, first, let's look at the commerce. And the commerce looks fantastic. You see here that commerce revenue dipped at only 29% growth last summer and has just been growing since. This is when they decided to lower the threshold for free shipments in Brazil, and you can see that it led to tremendous uptake in their e-commerce platform, growing at 50%. You thought it couldn't go faster than the 47% last quarter, but we are now sitting on 50% growth in commerce. But that's not the only part of commerce. In fact, commerce has two parts. The first is commerce services. The second is commerce product sales. Now, it's worth noting that within commerce services is advertising. Advertising is now, it grew 62% during the quarter, and it now accounts for 10% of all ad dollars, digital ad dollars in Latin America. That is very high margin revenue that is coming in. So that's part of commerce services, but there's a whole bunch that's included in there. Fulfillment, listing fees, things like that. And we see the same dynamics, that when they lowered the threshold for free shipments in Brazil, all of a sudden commerce services starts going up and up and up. The product sales were already doing very well, the first party product sales, and those continue to do well, growing 80% during the quarter. So those all look very, very encouraging. Next, let's look at unique active buyers. The unique active buyers has been growing like crazy. I mean, they were at 50 million 3 years ago, and now they're at 90 million. That's just 3 years. And this growth rate has been accelerating. It was just growing at 16%. Now Mercado Libre is the hot kid on the block. Users growing 26% during the quarter. Let's look at probably the most important metric for the commerce side, which is gross merchandise volume. Gross merchandise volume. So this is the value of all the stuff that is sold on Mercado Libre's platform. And that grew, look at this, also 43%, has been accelerating as we go across. Now I should point out, I should have done this when we did the unique active buyers, is that they are calling out something new, which is ecosystemic users, which means people who use both Mercado Libre and Mercado Pago on a monthly basis. Those users grew 37% in the quarter. That's the fastest rate that they've grown in 3 years. And it's also worth knowing that of those users, daily active users are actually growing faster than monthly active users. Monthly active users are still growing at a healthy rate, but the daily active users growing that fast just shows you that it is becoming more habitual, more behavioral in its bones. And Meli Plus, which is a little bit like Amazon Prime, the subscriptions to that grew 72% during the quarter. All those things combined because those users buy more stuff, which is why gross merchandise volume has been growing so fast. The number of items sold during the quarter also growing very fast, up 44%. You see the number of items sold right there. And then we've got the number of same and next day shipments. So again, huge jump we see rolling in here after the lower threshold and the investments in logistics. There was 225 million same and next day shipments. That was up 38%. This one is very interesting. The items sold per unique active buyer. The number of items sold per unique active buyer. Buyers have gone over the last 3 years from buying 7 things per quarter to 9 things per quarter. And that's important to point out because the other thing that you've got to keep in mind here is that the number of active buyers has been increasing. And usually active buyers start out by ordering fewer things and then build up. So the fact that the active buyers are increasing and the number of items per active buyer has been increasing, up 14% year over year, that's really impressive as well. Finally, we can look at the commerce take rate, which very simply is just saying, hey, out of all the gross merchandise volume that changes hand, how much does Mercado Libre get to keep as revenue? And the answer is a really impressive 25%. I'm going to change this to a different view, and I'm going to pull this back so you can see how this has changed over time. I mean, this is incredible. Advertising is helping. Logistics is helping. Meli Plus is helping. But at the end of the day, a 25.3% commerce take rate is very impressive. When it comes to the commerce side, it is incredibly popular, and every moat has a benefit and a barrier. The benefit to Mercado Libre is market share and being able to charge higher prices, but that will come in the future because right now their investments are in the barrier, and the barrier being that logistics network and that same-day shipping. They are betting that Sea Limited, Walmart, Amazon, Chinese players aren't going to go through the pain of building this out, and that will be the unique moat that Mercado Libre has alone in Latin America. Whether or not that plays out, well, we have to wait and see. But as I said, this is a two-headed monster. There are two parts to this, and the other part is the credit portfolio. So let's go over and look at that next. First, we've got fintech services revenue. These are just like merchant fees. And then we've got the credit revenue. This is their credit portfolio. If we look at both of these and see how fast they're growing, by the way, this purple one down here, you can barely see. Those are their point of sale devices. We don't even pay too much attention to them. So in terms of fees that are paid for using Mercado Pago to pay for things, that was up 31% during the quarter. Very positive momentum there. If we look at their credit revenue, this is the thing that's been exploding like bonkers. So you see it grew at 72%. It has had incredible growth rates. They're rolling out credit cards in Argentina. They've already done this in Brazil and in Mexico, and it has been very popular. A lot of uptake there. So on the surface, that looks pretty good, but it does require digging a little bit deeper. I pulled up the wrong thing there. The next thing we want to look at is monthly active users. And what we see is that there's actually been an acceleration in those monthly active users. Now, part of that can come from the credit card sales really driving adoption recently, and that growth rate at 30% is very encouraging, creating a lot of ecosystemic users of both Mercado Libre and Mercado Pago. Total payment volume. This one's really important. So total payment volume is how much money changed hands during the quarter. And the answer is about $101 billion using Mercado Pago. The important thing to note here is that it is growing faster than GMV. Remember, gross merchandise volume was growing about 50%. Total payment volume growing 56% means that people are paying for things off the platform too. The growth is coming from off the platform just as much as on the platform. And that is very positive as well. We can look at the total number of transactions that happened during the quarter. Overall, there was about 5 billion transactions. And as you can see, that has been accelerating. Thank you, credit cards, for that. And then we can look at the credit portfolio. Actually, let's look at originations first. So these are the number of loans that have been originated. And what we see here, again, is that this has really been accelerating. Look at the step up over the last quarter. The growth here was at 83%. This credit portfolio is becoming more and more and more important. We'll get to the benefit and the scary part of that in just a minute. But man, look at this credit portfolio. It was $3.5 billion 3 years ago. It is now $16.5 roughly billion today. 3 years, and the growth rate is a mind-numbing 78% per year growth. Whew, that is a lot. That is a lot. Now, overall, I also just want to point out that the take rate for fintech is lower. That's not surprising as they roll out the credit cards because the credit cards naturally have a lower margin. But here's the thing. This credit portfolio is getting so big that it becomes incredibly powerful. Now, you might think powerful is good, but powerful can cut both ways. It can be powerful in a great way, and it can be powerful in a bring you to your knees way. Now, one of the things that they often show is NIMAL. That's net interest margin after losses. So this is after bad loans that they make. Now, for the whole portfolio, it's been trending downwards for quite some time. And management has said this is largely because credit cards have a lower NIMAL, which makes sense. If people pay off their credit cards in full, there's going to be less of a net interest margin after losses. And so they broke this out and they said, here's our proof. Our credit card portfolio is growing. It's in the 40% of the total portfolio, and it's money losing now. But they have been very clear that that is actually normal at the beginning for it to be money losing, and over time it's more break even. And you can see that because the year ago quarter it was more break even, but now it is money losing because they're rolling this out. And what they want to show is that the personal loans and the merchant loans that they're making, which are between 50 and 60% of their loans, are actually quite profitable and increasing. Now, in general, that would be very good. But what if their profitability is increasing just because they're charging more, not because they're experiencing fewer losses? And I say that because they also publish this number right here. The non-performing loans as a percentage of the total portfolio. The non-performing loans that are 15 to 90 days past due took a step down from 8% to 7%. That's great. But the non-performing loans that are more than 90 days past due have increased by almost 200 basis points from 16.8 to 18.7%. Now, the fact that they're making such profits when the non-performing loans are approaching 20% means that they're charging huge amounts to loan this money out. But this is troublesome. And let me explain the main reason why I think that this is more troublesome than I might have thought before. It is that as the loan book grows and they lengthen the terms of these, then the denominator for the non-performing loans gets bigger and bigger. And a larger percentage of those loans haven't had a chance to reach 90 days past due. Because when your loan book is growing really fast, then the denominator grows, and some of that never even has a chance to get in the numerator for non-performing loans. So for the credit portfolio to be growing as fast as it is, and for this non-performing loans past 90 days due to grow as it is, that is the first sign of a warning there. And the first sign that I've seen of a warning in Mercado Libre's business in a long time. Does that mean that you should go out and sell? I'm certainly not going to sell out of the stock altogether, but as I said, this is my largest position, and this is the question that I'm going to be asking myself a whole bunch over the next week. Now, what am I going to watch as an investor moving forward? Well, the gross merchandise volume and the total payment volume growth are really important, but that number 3 is huge. The loans past 15 and 90 days due. Because the underlying fundamentals of this business are definitely solid. The e-commerce is rock solid. The credit portfolio, we just have to be careful with because it's so powerful. The moat is widening. The thesis is on track. We've got to keep an eye on those operating margins. But the question I'm going to spend the next 2 days asking myself, because this is such a big position for myself, is simply, how do I feel about the risk that could be hiding there in those non-performing loans? And that is a very, very serious question. Now, if you'd like to follow along with what I'll be doing, you are an excellent candidate to join Stock Investing Mentor, my investing program. Now, it has 3 pillars. The first is real access to my real-life portfolio that is 90% of my family's net worth. Second, you get access to the antifragile stock universe. Every stock that I own and cover, rated by antifragility and valuation, along with the key metrics to watch for each company that I own, and live training 1 hour every week, Thursday, noon Eastern, that's recorded, and 24/7 access to a live online investing community. And oh yeah, it also comes with Stock Simplifier Pro absolutely free. That's a $400 value. Now, how does Stock Simplifier Pro work? We'll get to that in a minute, but if this interests you and you want 10% off an annual membership, top link in the show notes below will get you just that. Now, I'm going to go on over to Stock Simplifier Pro to show you a little bit of how it works, but also to do the valuation work on Mercado Libre. So if I pull up Mercado Libre, there's a whole bunch of different things that we can see here. We can learn about what the business is, what they do, what kind of position they have in the market. We can learn about the company's moat, its risks, And finally, it's valuation. Now, we could look at things like the price to earnings ratio of 52. That might seem very, very expensive. Or price to free cash flow of 8, which seems very, very cheap. But of course, we know that it's cheap because it's a fintech, and that's not really the best way to look at it. I think the best thing to look at here is reverse discounted cash flow analysis. Now, I believe that Mercado Libre definitely has a moat, which means that I'm going to make this terminal growth rate 3%, but I'm actually going to bump it up a little bit more because revenue has been growing above 30% for as long as I can remember. And so I'm going to up this terminal growth rate to even 4%, okay? I'm going to leave the discount rate at 10% because I want to know what are the assumptions baked in to make this a market matching investment that gets 10% per year. Now, when we get to the free cash flow margins, this is where we need to make major adjustments because they're sitting on 35.3% free cash flow margins right now, but those are total, it's a smokescreen because they are a fintech company. We've got to pull these way down. Some people say it should be 25%, 20%. I'm going to pull this all the way down to, let's just call it 10%. Now that is very, very conservative. Very conservative. Okay? So if they just have a 10% profit margin, it could be free cash flow or net profits, just a 10% profit margin in the future, optimized, with a 4% terminal growth rate, 10% discount rate, then they need to grow their revenue by 10% per year over the next 10 years. Well, how do we feel about that? Well, let's look and see where revenue growth has been and where analysts think it's going. Well, here's where it's been. Amazing. Since 2019, never grown slower than 37%. And we've reaccelerated to 46% growth. So you can look at this and say, this looks like an amazing deal. You should go out and buy it hand over fist. And it actually gets even better because if we pull this out and see what analysts are expecting, 41% growth this year, followed by 27, followed by 22, it might look even better. And guess what? Those estimates have consistently, every time, been wrong. You can see they are consistently raising their expectations. When they talked about last year, they started guessing that it'd have 21 billion in revenue. They ended with 28. When they started making estimates for this year, they said 31 billion. We're already over 40 billion. Next year started at 45. We're already up to 52 billion. So I don't think it's much of a stretch to say that this company could grow at about a 30% clip over the next 3 years. I don't think that that's a stretch. And if we put that in there and say over the next 3 years, let's say that they grow 30%, well, then look at this. Then we're saying that the company basically doesn't need to grow at all for years 4 through 10, which makes it seem like an incredible deal. And it is going to be an incredible deal if the loan book is healthy. If the loan book is healthy and it proves that out, and we go through a credit cycle, and Mercado Libre has done a great job of making loans, this will be one of the best investments that you can make today. But if it's not, it is very hard to predict how far this stock could fall. And those loans past 90 days due is something that investors need to think about. So what am I going to do? Again, click below, Stock Investing Mentor. You'll find out. I'm going to need some time to think about it. But I would love to know what you thought of the quarter, the valuation, and the loan book in the comments section below. Till next time, Brian.